Okay, well we are ready. We are ready to start chapter 11.
So looking at chapter 11, it's basically like macroeconomics, right?
Do what now?
Chapter 11 is basically macroeconomics in a nutshell.
Well, we're doing bonds.
Yeah.
So,
No.
not really.
This was not that bad. Yeah, I'm well trying to eat healthy. I have to lose 15 pounds.
Oh, 2 of the
Because I'm on my vacation.
Okay, so chapter 11. Let's get started. Okay, so chapter 10, we were dealing with current liabilities. So we dealt with like payroll tax, notes payable, installment notes, all of that fun stuff. Now we are ready to talk about long-term liabilities. Okay, so we are going to discuss bonds. So a bond is an interest-bearing note, but it's not the same as a regular note, okay? Bonds are completely different, but similar to a note, we do have interest attached to it. But unlike a note where we pay the full balance plus interest, with a bond, we just make interest-only payments until the bond matures, and then we pay the face value back as well. So it's a little different. Really, when we're talking about bonds, bonds are used to infuse cash into the business. So usually bonds are more of a higher dollar, we're not trying to borrow money or, we are borrowing money, but we're not trying to get a loan. We're not, selling stock. We're wanting to get cash into the business quickly, easily, without having to go through loan approval processes and without changing the ownership structure of the company. So when we want to do that, we issue a bond. Okay, so bonds are just a little bit different. So basically how bonds work, again, is we issue bonds, people purchase them from us, so they give us cash. Sorry. It's really loud. Now we're awake. Yeah, I'm just kidding. You won't lose it, right? So bonds, how they work is we issue them at a certain face amount or dollar amount of value. People purchase them, so they give us cash. And then bonds can have a different life. So it could be like a 2-year bond or a 5-year bond or a 30-year bond. And over the life of that bond, we're going to pay the people that purchase the bond interest, usually every 6 months. So we're making regular interest payments to them. So it's a win for them because they're getting interest every 6 months on these bonds. And then when the bond matures at the end of its, years, whether it's 2 years, 30 years, whatever, we pay them the face value back. Okay, so we're making regular 6-month equal interest payments. So every payment is the same, for 6 months for the life of the bond, and then when it matures, we pay them back the face value. So bonds are a little different. And we're going to look at in this chapter, we're not going to get into like all the different types of bonds. We're just going to look at basically like standard bonds, both issuing at and selling at face value, and then we're going to look at discounts and premiums on bonds. So those are the only bonds we're going to look at. If you read through the chapter, if you go through it, there's like callable bonds, and there's all kinds of different bonds that are out there. I want you to understand the basics of how bonds work and how to account for them. Other finance classes are going to go into all the different types of bonds, and basically there's different bond structures where, depending on when the bond was issued, we could make it where we could call the bond or ask for it to mature faster. So maybe like a 10-year bond, but maybe after 5 years we want to go ahead and pay them back. So there's all kinds of different bonds, but again, we're going to stick with the basics. So when we issue bonds, we usually issue more than one at a time. So it's usually like when we do a bond issue, it could be 10 bonds or 500 bonds, you know, all at the same face value. So different people are purchasing these bonds. Okay. So we have the face amount of the bond or the principal amount. Okay. They're usually in kind of increments of 1,000. Okay. And then again, when the bond matures, we're going to pay back that principal or face amount. Okay. Most bonds pay interest semi-annually or twice a year. Okay, usually like June 30, December 31st on a typical fiscal year. And that's what we're going to see in this class. So we're always going to have interest payments every 6 months. Okay. And then it just gives us terminology here. The underlying contract between the company issuing the bonds and the holder of the bonds is called a bond indenture. Okay. Again, we're just going to deal with what we call term bonds. So term bonds are ones that they have a mature date and we're paying back the face value at that maturity date. You can, again, have different types of bonds, like a serial bond. That's one that's going to have multiple maturity dates. So we may pay them back, you know, like 1,000 at a time or something. We're not going to deal with that. Again, like I was mentioning, you could have callable bonds or even convertible bonds. So it's just good to know that all these different bonds exist out there. But again, we're going to focus on term bonds only as far as the accounting side of it. So when we issue bonds, how much cash we receive for that bond depends on a few things. Well, number one, it depends on the face amount of the bond. You know, how much is the actual value that we've established on this bond. But also the interest rate is important and the market rate of interest for similar bonds. So as we get through this, that's how bonds get a discount or a premium attached to them, because basically what happens is, say I issue bonds today. Well, we know, you know, we're talking about the market, like the stock market. If you've ever watched the ticker, we know stock market prices change daily, if not by the minute. So say we issue bonds today, and we're going to deal in really high percentages to make it easy, but bonds are not this high. Say we issue with an 8% interest rate. Tomorrow the market situation could change, you know, and the going interest rate could be 7.5%. Well, now we're paying more interest than what the current market rate is. So we consider the current market rate of interest for other bonds that are similar to ours when we are actually receiving the proceeds, and how we determine whether we're going to discount or premium, have a bond that sells at a premium. So we'll get into that a little more later. It's just good to understand, you know, bonds are still part of like the market, you know, so the market does drive the interest rate. But bonds are also more secure, you know, because bonds, once they're established, once they're issued and we're starting to pay interest and that face value gets paid back, you know, it's not affected after that. So it can't be like stock market crashes, oh, bonds change. No, once it's issued, once payment starts getting made, you know, they're much more of a secure investment.
It does not change ownership?
It doesn't, different bonds can though. So like we could technically, like if I was holding a bond, if I was a bond holder, I could technically sell it to someone else and then they would get the interest payments and the, you know, but we're not going to deal with that in this class. So yeah, there's so much with bonds, because there are bonds that do change interest rates, and there's, you know, convertible bonds that we can convert into stock. Yeah, we're going to keep it simple because bonds are kind of tricky as far as how we account for them.
But with the bonds, like the company, say like a large company becomes like a small company all of a sudden, are those bonds basically worthless so they can't pay them back for it, or?
Yeah, we don't really get into that in here, honestly. That's like advanced accounting. But yeah, I mean, it depends. You know, when we issue those bonds, we're guaranteeing that we're paying them back. So that would get into, we would have to probably file bankruptcy if we can't afford to pay back the debts that we've incurred, you know, because that really gets into, yeah, bigger issues. But that's a good question. But yeah, hopefully we're going to assume that we have lots of money. Yeah. It's a nice assumption, isn't it? We're a really profitable company. We make lots of money. We can pay back all of our debts. So the face amount or the principal amount and the interest rate are identified on the bond indenture. So on the bond itself, when we issue the bond, you actually get like a certificate, a bond certificate that lists, you know, the face value, the maturity date, the interest rate, all of that. Okay. The interest rate that's listed on the bond is also called the contract rate. Okay. And then again, we have what we call the market rate of interest, which may also be called effective rate of interest. We're going to call it market rate of interest. And that's based on the buying and selling of other bonds currently on the market. Because we could issue bonds today and we have a competitive interest rate, but those bonds may not be purchased right away. It's not like just because we issue them today, people have to purchase them today. Okay, so that's when we get into changes in interest rate.
So bonds aren't really like that. It's not like a risk.
Not really. Yeah, you get it back. So bonds are very low risk as far as an investment option. If you have the cash to purchase bonds, they are a good investment option. Yeah, they are pretty low risk.
They shouldn't be like dividends off of it, like compared to a stock.
Correct. Yeah, you're not actually, with a bond, when we purchase a bond, we're just basically loaning the company money. That's what we're doing. Usually at a decent interest rate, though. It's not going to be super high. Like you're going to see a higher return on like stock market accounts because bonds are low risk. I mean, again, we won't get into too much on markets and stuff like that. That's a whole nother ball game. But you know, if you have stocks that are more risky, usually they have a higher rate of return. We just don't know day by day, you know, what we're going to have happen. Since bonds do have such a lower risk, it's kind of like if you've ever put money in like a CD, you know, a certificate of deposit. Those are lower interest rates, but you can kind of lock in an interest rate over time. So bonds are kind of, they're not CDs, but they're similar to that as far as the risk level. So most bonds, again, there's lots of different types of bonds, but just a standard term bond is pretty low risk. So again, we're going to look at really inflated interest rates. I'm sure you could Google what the current, you know, going rate on a bond is, and I'm sure it's not super high. We just use higher interest rates. It makes it easier to do the calculations. But yeah, bonds are low risk. They're a good form of investment, you know, especially if you're not wanting to worry about your money being lost, because it is guaranteed that you'll get the face value back plus these interest payments, you know, unless the company files bankruptcy or something like that. But, you know, there's still always some risk involved in any investment. But it's a better investment option if you're wanting something low risk. But again, you're not going to see the high rate of returns you would on money market accounts.
So it's probably a dumb question, but like, do you see like big successful companies really ever like sell?
Yeah, I mean, they sell bonds. Yeah, all companies could possibly sell bonds because what they're doing that for is maybe they want to infuse cash in the business to expand. You know, they want to build a new factory, for instance, or something. And they're like, well, we could go to the bank and take out a loan, but that affects our debt structure even more. You know, we have to go get credit approval, and maybe we already have a loan and we don't want to deal with taking out, you know, more credit, because bonds really don't affect our credit. They affect our debt level. Obviously, it's still a debt. It's a liability. But we don't have to go through the bank and go through all that approval process, submit a business plan, you know, all that rigmarole. And then we could issue stock, you know, we could sell more stock, but then we're changing the ownership of the company, and we may not want to do that. So bonds are a nice way of infusing cash into the business without changing ownership and without going through the bank to get a loan. So really any size company is and could possibly issue bonds. Yeah. It just depends on what their goal is.
Do non-public traded companies also do bonds as well?
Yeah, publicly traded companies are the ones that usually are issuing bonds, honestly.
I mean the non.
Oh, non-public? Yeah, I mean, other corporations could issue bonds. And you're going to see more on publicly traded, probably. Yeah. So when we're looking at bonds, we're always going to look at the contract rate. That's the stated rate of interest on the bond itself, you know, what we deemed the interest to be. And we compare it to the current market rate of interest. So what's the current, you know, market paying for bonds? And then that will determine whether the bonds sell for more than, less than, or at their face value. So we'll get into that in a little bit. It kind of already, well, I guess we'll get into it right now, right? We'll deal with it later though. So if the market rate is greater than the contract rate, so our stated interest rate is lower than what people can get on the current market. So we're providing them a lower interest rate than if they went to a different company to purchase a bond. So our bond is less attractive, right? It's paying less interest. If we have a bond that our stated or contract rate is less than the market rate, then we are going to discount that bond. Selling a bond at a discount means they're going to give us less cash up front, less than the face value. So we're going to basically give them a discount on the face value of the bond. So we're getting less cash up front because we're paying them less interest over time. Okay. So we give them a discount to kind of make it equitable. The easiest in the first example we'll look at is if the market rate equals the contract rate, then we issue the bond at the face value, calculate interest, pay back the face value. It's pretty simple. Okay. And then if the market rate is less than the contract rate, so our stated contract rate is higher than what bonds they could get over, somewhere else, then we're going to sell that bond at a premium. So they're going to give us more cash up front because we're paying them more interest over time. So really you can kind of see issuing bonds, the whole goal is to kind of make them attractive. We want a bond to be attractive to sellers and still be, a win-win. So we don't want it to be sold and pay a higher interest rate than they could get somewhere else. So when we look at issuing a bond, we really want it to kind of be in sync with the current market. Okay. So that's why we either discount or sell it at a premium if the market rate is less than or greater than the contract rate. So price of bonds could be quoted as a percentage of the face value. So for example, we could have a $1,000 bond quoted at 98 or 98%. That's being sold at a discount. Anything below 100% is a discount. Okay, so I know a bond is being discounted if it's being sold at anything less than 100. So we have 98, so we're truly just taking 1,000 times 98%. So the money we would receive on that bond proceeds would be $980. And on the flip side of that, if we had a bond quoted at 109, it would be premium. We would get more money up front. So we take the face value of 1,000 times 1.09 or 109%. The fun part with bonds comes in when they are sold at a discount or a premium. Okay, if we issue it at face value, they're pretty easy to account for. However, if we sell it with a discount or a premium, we have to amortize that discount or premium over the life of the bond. Amortization is just spreading out. That's all that means. So when you amortize something, you're taking it and spreading it out over the life of the bond. So what that means is if we offer a discount, we calculate the total discount amount, and we need to recognize a portion of that discount, every year that the bond is valid until it matures. This all goes back to that matching principle again. When we lower that value of the bond, it's an expense to us to do that. So we need to recognize that every year. Okay, they're going to give us less cash up front. So we're going to, take that discount really up front, but then we're taking the expense of that discount and we need to spread it over the full life. Okay. And same with the premium. The premium is actually a gain though almost, right? We're getting more money, so it's going to reduce the expense of this bond over the life of the bond. So let's look at one. We'll start with the easy one. Bonds issued at face amount. So we'll look at one and then we'll do one on the practice together. So it says, assume that on January 1, year 1, Eastern Montana Communications issued the following bonds. So this bond has a face amount or a principal amount of $100,000. The contract or stated rate of interest is 12%. Interest is paid semi-annually on June 30 and December 31st. And the term of the bond is 5 years. So we're going to make semi-annual or twice a year interest payments for 5 years. And the market rate of interest is 12%. Well, again, here we have the contract rate and the market rate equal. So we don't have this selling at a discount or a premium. It is going to be sold at face value. That makes life really easy. When we issue a bond, the issuance of the bond is pretty simple for a face value bond. Okay, we receive cash, so cash is debited for $100,000, and then we credit the long-term liability account bonds payable. It's just like any other liability account. We owe them $100,000. So that's when the bond was issued at the face value. Okay. Every 6 months, we get to make the same journal entry to account for interest. Fine. Once you get the first one down, you know, it's very redundant after that. So interest is really calculated the same way you calculate interest on any note. You take the principal times the interest rate times the time. Okay. Well, in this case, the principal was $100,000. We have a 12% interest rate, and we pay twice a year. We pay every 6 months. So they multiplied it by 1/2. It's the same as doing 6/12, right? What I always say is easier, though, is you could just take that 12% interest rate and divide it by 2. Okay? You're wanting a semi-annual interest rate. A semi-annual interest rate means you're making 2 payments a year. So the easiest way to deal with that is just take your annual interest rate and divide it by 2. So we're paying interest on bonds, and that'll always be the case in here with bonds. So you can always just take the annual interest rate, divide it by 2 to get the semi-annual or 6 months worth of interest. So really we could take 100,000 times 6%. So much easier, right? I'm dealing with fractions. It's the same thing. So every 6 months for 5 years, we are going to pay them $6,000 in interest. Not a bad deal, right, for them. So every 6 months, we are going to recognize $6,000 of interest expense as a debit and credit cash, okay, for the interest paid. So again, when we issue bonds at face value, they're pretty simple. The issuance is at the face amount. Every 6 months, we're doing this exact same journal entry. Well, for 5 years, twice a year. So we're going to have 10 payments of interest over the life of this bond. So all total, we're going to pay them, what, $60,000 in interest on a $100,000 bond? Again, these are really inflated. If you can find a 6% bond, please tell me. But that's really good. Or actually, it's a 12% bond. Okay, so we do that every year, twice a year. And then when the bond matures, so it's been 5 years and we've made 10 interest payments and now the bond has matured, we just pay it back. Debit, bonds payable, credit, cash. Okay. So face value bonds are really pretty simple. So while we're still on the face value, go ahead and go into Canvas and open up the Chapter 11 practice. Chapter 11 practice. And we'll do one issuing bonds at face value. As you can see, we only have 3 to do. So we're going to do one at face value, one at a discount, and one at a premium. So not too bad. Okay, so this one, a little bigger. Again, we're dealing with bonds that are issued at face value. So contract rate of interest equals market rate of interest. So Thomson Company produces and distributes semiconductors for use by computer manufacturers. Thomson issued $900,000 of 10-year 7% bonds on May 1st of the current year at face value. Interest is payable on May 1st and November 1st. Okay, so, you know, it depends on when the bonds are issued, when the interest gets paid. Since this bond was issued on May 1st, we're going to make interest payments on May 1st and November 1st. It says the fiscal year of the company, though, is a calendar year. That's important for our third journal entry. So May 1st, when we issue the bonds for cash at their face amount, what would I debit and credit?
Cash.
Very good. Cash is debited and bonds payable is credited. And for how much? Yeah, the face value, the $900,000. Okay, so when we have our contract rate is the same as our market rate, This one is sold at face value. So cash is debited, bonds payable is credited. How would I calculate interest on this note?
Would be 7 months of interest.
Well, it'd just be 6 months. Our interest is payable May 1st and November 1st. So when we pay interest on November 1st, it'll just be 6. Bless you. I think I lost my black marker. Oh, there it is. Oh, it's under the desk. Okay, so what is my interest calculation? How would I calculate interest?
900,000 times 7% divided by 2.
Very good. So we take our face value, the 900,000, times a semi-annual interest rate, which would be 7% divided by 2. So you could take it by 3.5%. Okay. So how much interest do we owe them every 6 months?
31,500.
Very good. 31,500 is 6 months worth of interest. Okay. Well, November 1st is our first interest payment. So what would I debit and credit there? Very good. Interest expense gets debited and cash gets credited for the 31,500. Okay, so 31,500 debit interest expense, credit cash. Okay, so that's pretty straightforward. Again, when the next May rolls around, we're going to have the same amount of interest that we're paying them. The only difference is they decided to issue these where we're paying interest May 1st and November 1st. So on December 31st, it says record accrued interest for 2 months. Because what has happened there with the bond, it's kind of like a note, right, that's due the next year. We paid interest on November 1st. Well, now we've had all of November and all of December that interest has accrued, right, on this bond. Then we're not going to pay them until next May, right? We're going to wait another 4 months to pay them the full $31,500. However, we know, based on, well, all of our good adjusting entries, that we have to recognize any interest that has accrued. We're not paying the interest yet, but we need to recognize it. So how would I calculate how much interest to recognize?
You just divide 31,500 by 6 and multiply that answer by 2.
You certainly could. Yeah, you could divide this by 6 to get a monthly amount and then multiply it by 2. Okay? There's lots of ways of doing it. So you can do that and get a monthly.
Divide mine by 3. It came up with the same answer.
And you could do that. You could divide this by 3 to get, 2 months worth because it's 6 months. If you ever forget, or if that doesn't make sense, just go back to your principal times interest times time. Okay, so you could take 900,000 times 7% times 2 over 12 for 2 months worth of interest. It's the same thing. So if your brain didn't get, I could divide that by 6 and multiply by 2 or divide by 3, which, makes sense. Revert back to this. Okay. Either way, you'll get the same answer. But remember, this is just 2 months worth of interest then. If you always remember, the interest rates that they're giving us are always annual rates. Okay. So how much interest is just 2 months worth?
10,500.
Very good. 10,500. And what would I debit and credit?
Interest expense and interest payable.
Very good. Interest expense, because we are recognizing the interest that has accrued. And we're going to credit interest payable because we're not actually paying them this interest yet. So we'll pay them the full $31,500 May 1st when that interest payment comes due. Okay. Any questions on that one? Okay. So again, bonds issued at face value are pretty straightforward. It's when we get into the discounts and premiums that they get fun.
What was that other way again?